Trading expectations for 2024. So this time of year, lots of people are setting goals and having thoughts on what they would like to achieve through this coming year. But what is realistic? Well, let's start this off with a question that I had a few months ago from a new trader saying, is it realistic to make circa 5 to 10% per month um, with a max drawdown of 3%. So the reason why I'm starting off with this story is because your trading expectations need to be realistic. So if you said 10% a month, so what's that? 120% a year non-compounded. So it's more than that. I've just not known off the top of my head what that is compounded. But let's say it's 120% in a year. So 120% with a maximum drawdown of 3%. Is that realistic? It's about as realistic as my dog flying along with the pink elephant. So no, it's not. It's drastically unrealistic, and this is the problem that a lot of traders have, especially is that they set unrealistic expectations with regards to what they think is achievable. So let's have a look at what is realistic. Firstly, is it possible to make 120% in a year? Yes, it is. Is it possible to do it with a 3% drawdown? No. Highly unlikely. The first thing to note is whatever your trading return goal may be. So let's say it's 100%. If you're trying to make 100% return in a year, I'm not saying that it's going to happen, but you should allow for a 50% drawdown. So generally speaking, whatever the return is, then 50% of that return would be, you have to allow for as a drawdown. So if you're looking to make 30% in a year, then generally speaking, you might want to allow for up to 15%. I'm not saying that you're going to go to 15% drawdown, but it's a potential. In order to get the reward, the risk has to be measurable with that. So the higher the return, then the bigger the potential drawdowns that are going to happen. So that may help give you an idea, because when people say, well, how much money can I make, or how much percentage return can I make, what we first have to look at is, well, what's your risk appetite? What's your risk appetite? So it's all very well looking at returns, but what's your risk appetite? Because there's no point saying, yeah, I want to make 100% return if you don't have the tolerance to potentially have a drawdown of up to 50%. It may not be 50%, but you're going to have more measurable drawdowns along with that. So that's the first thing, because then you can start to consider your returns. So if you said, well, my risk appetite is such that I'd want a maximum drawdown potential of, let's say, 20%. So then that you're in the ballpark for looking at around about 40% or so potential returns if your potential drawdown is 20. You may not go to 20%, and you may still make 40% or 50% in a year, or maybe 60%. But you have to allow for that. So by doing that and saying, okay, whatever my risk tolerance therefore is, it gives me a ballpark of, okay, about twice that much or so is is something that is a realistic return. So relative to the risk that I'm willing to take here. So now, of course, if you are trading a mechanical systemized type approach to trading, then you may say, well, back tested, Charlie, my back tested max drawdown was 10%. Okay. Historically on the back test I've done. Well, if that's the maximum drawdown historically that it's had, I think you should always allow for 2 times that, up to 2 times. That's if your strategy, then that's still saying that it's trading within the boundaries that you've set. What I'm saying is that you've got a back-tested approach, but back-tested data is just that. It's back-tested on historical data, not on what's going to happen in the future. So you have to allow, even if the system is still fine, you have to allow for the system, I say system, or the mechanical approach, to potentially expand that historical drawdown in the future to potentially 20%. It may not go that far, it may only go to 15%, but you have to allow for that. And if it gets to 20%, then you might have to then stop trading with it or do a major review. So if it goes outside of those historical norms by more than twice that. So we're starting to build a picture here based on your risk tolerance. So, okay, what is your total risk tolerance? What would you be prepared to take in order for the returns that you're looking to make? And so if you say, okay, well, I'm looking, max risk tolerance is X, right, okay. We now have some ballpark figures. You can go and backtest a given strategy, but know that backtesting still has a limitation in that it is tested on historical data, and that going forwards things may be different. They may not be, but you have to allow for that. So within all of that, you can then say, right, this is my max tolerance. And really, there is no right or wrong answer when it comes to what is your risk tolerance. Different people are going to behave differently. So for example, if you've got someone who's trading with $1 million in a trading account, then the person who's trading with $1 million in a trading account may not, may be more than comfortable trying to achieve roughly a 20% return in a year. I'm just making this up, but that is that a lower percentage return is more likely with people who are trading with larger capital bases. It's more likely that they'll say, no, I can. That's still a $200,000 return, and I'm comfortable with that because a 20% return means that what's my max drawdown? Well, potentially a max of 10% drawdown, which someone with larger capital base is not going to be necessarily willing to take on the higher volatility that someone with, let's say, $5,000 in a trading account is going to be prepared to have. So someone with a $5,000 in a trading account may not be happy with 20% return. They what, trade all year and only make $1,000? Well, yeah, but you're only trading with a 5,000. So, but nevertheless, they may be more willing to have a higher volatility potential. So they may say, well, actually, it's $5,000. I'm actually willing to risk let's say a 30% drawdown or whatever it might be. And so therefore, yes, they can stomach higher volatility on their account in order to go for higher percentage returns. But again, it's not always going to be the same. Everybody's got their own personal risk appetite. And I think that's the most important thing. Think about what your risk appetite is first before thinking about what sort of return you want to make, because the returns you can then get a half decent idea of the sorts of returns you can make based on the types of max drawdown that you're willing to have. So forget the maximum drawdowns of 3% in order to make 100%, like that chap who emailed me a few months ago. That is so unrealistic, it's ridiculous. But he was new to trading, so he doesn't know any different. So I've given you some boundaries as far as realistic drawdowns relative to returns, and then you can then look at that. Once you've done all of that, chuck it all in the bin and focus on the act of trading. People have too much focus on their goals, on their percentage return goals, and that can then take away your attention from executing the best you can. So by all means, have a think about in your trading plan about roughly the sorts of returns that you think you would like to achieve, and then pop it in the drawer and forget about it and get on with the art of trading and the act of executing as best you can. Because otherwise, if you're constantly thinking, oh, I haven't made as much money this month or whatever, then what are you more likely to do? You'll start to make mistakes, or you're fretting about your performance. And so you're not focusing on the act of trading. So yes, by all means have goals, but pop them aside and then your main focus should be on your processes. That's us kicking off the first video of the year from CBT. I'll see you at the weekend.